Mortgage interest isn't always tax deductible. Surprised? Most people are. But here's the thing. It all depends on a few key factors like how you file your taxes, the type of loan you have, and even when you got your mortgage. I'll break it down so you can avoid these costly mistakes and potentially save big on your taxes. Hi, I'm Kevin Martini, a certified mortgage advisor with the Martini Mortgage Group. If you're buying a home, refinancing, or just trying to understand how your mortgage fits into your financial picture, then you are in the right place. Stick around. By the end of this special podcast episode, you'll have the crystal clarity of understanding when mortgage interest is and isn't tax deductible. This is episode 204 of the Martini Mortgage Podcast, which is called When Mortgage Interest is Deductible. Now, before we start, I need to make those compliance people happy. So, I'm Kevin Martini, a certified mortgage advisor and producing branch manager, NMLS 143962, with the Martini Mortgage Group at Gold Star Mortgage Financial Group Corporation, NMLS 3446, equal housing lender. This podcast is here to inform, educate, and entertain, not to provide legal or professional advice. Now, with that out of the way, let's start to dig into the big question. Do you itemize your tax deductions? Because if you don't itemize, you can't claim the mortgage interest deduction period. For 2025, here is the standard deductions, what they look like. $15,000 for a single taxpayer, $22,500 for a head of household, and $30,000 for a married couple filing jointly. If your total deductions, including mortgage interest, do not exceed these amounts, it might make more sense to take the standard deduction. But every situation is unique. Remember, I'm a certified mortgage advisor, not a certified public accountant. So work with your tax professional to discover the right call for you. Next up, is your home a qualified residence? This is a key requirement for deducting mortgage interest. Now, here's how it works. Your primary home qualifies. No questions asked. In addition, you can also claim one secondary home, like a vacation property. However, if you're dealing with an investment property, that is a completely different story. The tax treatment for rental or investment properties follows an entirely separate rule. For those, check out IRS publication 527. This one trips up so many people. To qualify for a mortgage interest deduction, your loan must be classified as an acquisition indebtedness. Wow, acquisition indebtedness. What a big words. That means the funds were used to buy, build, or improve a qualified residence. Here's the limit for acquisition indebtedness. For loans taken out after 2017, you can deduct interest on balances up to $750,000. For older loans, in other words, for home loans taken out before 2017, the limit goes up to $1 million. Now, let me share a couple Kevin Martini auditory examples. Let's say that you bought a $500,000 home with a $400,000 mortgage. You can deduct the interest because the mortgage was used to buy the property and falls within the $750,000 limit. Of course, assuming that you itemize. Now, if you paid cash for that home, then took out a $400,000 cash out refinance for unrelated expenses, I regret to share that mortgage doesn't qualify because it wasn't used to buy, build, or improve the home. Now, if you close on that loan before December 16th, 2017, you're in a slightly different game. Your acquisition debt limit is $1 million. And here's the good news. You keep that limit if you refinance, as long as you don't increase your balance. Let's say you're refinancing a $950,000 home loan. If your new loan amount does not exceed $950,000, you can still deduct the interest under the $1 million rule. And this applies even if you're consolidating your pre-2017 home's equity used for a qualifying home expense. Finally, let's clear up one more misconception or common question. Does this apply to investment properties? The short answer is no. Everything I have shared, itemized deductions, acquisition indebtedness, and qualified residence applies to primary homes and vacation homes only. If you're dealing with rental income or other investment property issues, I recommend checking out IRS Publication 527 or consult your tax professional. If this feels overwhelming, don't worry. That's what I'm here for. At the Martini Mortgage Group, we help homeowners and buyers navigate not just their mortgages, but how those mortgages fit into their overall financial strategy. If you're thinking about buying, refinancing, or just want to explore your options, reach out to me. Let's make your homeownership journey smooth and stress-free. Again, my name is Kevin Martini, and I can be reached by dialing 919-238-4934. Thank you for tuning in to episode 204 of the Martini Mortgage Podcast called When Mortgage Interest is Deductible. If you found this helpful, don't forget to like, subscribe, and share this podcast episode with someone who needs to hear this.